Today I'm going to be talking to you about the difference between venture capital and private equity. Are you ready? Let's begin. Hi everyone, my name is Avishai and I do videos on the stock market, on startup investing, on starting businesses, and in general, everything that is interesting to entrepreneurs and to investors alike. Now, today I'm going to be talking about the difference between venture capital and private equity. This is also known as the question VC versus PE. What is the difference? So what is the difference between a VC and a PE? Well, we talked about venture capital on the channel, so let's recap. Venture capital is looking for younger, early stage startups, businesses that have a revenue growth of the top line, companies that are growing their top line 50 to 150% year over year. And these companies can be losing money, they can be burning cash, but as long as they're growing, venture capital wants to be there on the ground floor to invest on them. They'll either look to do a round A, a round B, round C, D, E. Those are the stages a venture capital wants to invest in. Not a second before an IPO or to invest in a company that is already IPO'd. PE, on the other hand, is looking for that stage of maturity. So PE will usually either look to invest in a company right before an IPO, or PE might be even looking to take a public company back to being private. Now, when we're talking about PE is usually looking to invest in kind of sure bets, something that is very calculated, that they know for a fact is going to make money. It's very hard for PE to lose money. It is in a different business than venture capital. Venture capital usually invests in an early stage, hoping to get multiple exits. PEs usually go into investment with a plan in mind. And that plan usually is not the exact plan the founder or the CEO has. So another huge difference would be that VCs will look to take equity in a startup while having the founder or the CEO keep leading that startup and making sure that his vision and his work is what propels the company forward. PE, on the other hand, will not look for that. PE will usually look to change management or to create a turnaround plan for the company that the CEO might not necessarily fully like. Now, when we're talking about PE investments, we're usually talking about investments that take most of the cap table. PE does not like to be a minority stake. PEs are going to look to invest in companies where they can take majority stake in the shares. Venture capital usually knows that it is going to be very hard, even with pro rata rights, the rights to reinvest, to have more shares inside a startup, because there are going to be rounds and there's going to be delusions down the line. Now, a few moments ago, I talked about how PE can also take a public company private, and a good example for that would be Dell Computers, that at one point had gone public and then gone private, just to go eventually public again. Another thing you should know about PE is that they like to do leverage buyouts, meaning that a lot of the money that the PE is going to be used to do a buyout of a company is going to be money that is on loan, or basically debt. While venture capitalists will usually use their LP's money to get into investments, a PE firm will usually do some financial wizard work and try to invest or buy out a company through money that is not necessarily on hand at that specific moment in time. So let's summarize the differences between VCs and PE. VCs are looking for young startups that have a long road ahead of them, while PE will look for stable companies that usually need a change or two in order to be more efficient, and they're looking for companies that have a high level of maturity. VCs will use their own money, while PEs will sometimes take leverage and use that to buy out a company or to take a majority stake in it. VCs want to see the founder, the CEO of the company, move the company forward. PE will usually want to take a company in a certain direction that does not necessarily align with the founder/CEO. VCs are deep in the business of bets, while PE are in the business of knowing what they're about to do before they do it, and they usually like to invest in sure things. Like I said, in the PE business, it's hard to lose money, while in the VC business, it is actually pretty easy to lose money. Last but not least, while VCs are looking to stick around, PE are not necessarily looking to stick around. A PE firm can take a company over, do a turnaround move, maybe a year, maybe two, and then re-IPO the company or resell it to a bigger company for an exit. And that's how usually PE conducts their business. VCs, they're looking to see their company 10x, 100x, really depends on the stage. I hope you found this video useful. If you did, this is the time to hit that like button. And if you like content like this, subscribe to the channel so I can see you again. And don't forget to hit that bell for notification so you can get notified when a new video comes out. Thanks for watching. See you next time.